There was much trepidation about Reeves's budget on October the 30th. Something thought to be lined up for a tax raid was inheritances, along with our incomes and capital gains. Perhaps with an eye on the plunging opinion polls, Labour opted to shelve such impositions on the average person, deciding instead to hit employers with a national insurance rise. That of course would lead to slowing wages and fewer job opportunities affecting the average person, but the hope was nobody would notice. People who did take an extra hit on inheritance tax, however, were business owners and farmers. The current quite complicated regime does allow elements of a business or farm to be passed on without incurring inheritance tax. That would all change in April 2026. Essentially, a business or farm worth more than £1 million would be liable for 20% inheritance tax when passed on by the owner. That is not a high threshold for the total assets of a business or farm. The inheritors would have 10 years in which to pay the money off. On December the 4th, this was tested in Parliament, where the Tories arranged a debate and vote on the new proposal. Alas, the Labour supermajority won the day. If a farm owned by two people were to be left to their child or grandchild or direct descendants, the threshold would be £3 million. If a farm were owned by one person and left to a direct descendant, the threshold would be £1.5 million. In both cases, there would be a slightly lower threshold if the inheritor was not a direct descendant. Let's take a family farm left by a mother and father to their son. It's worth £3.5 million. That is £500,000 over the threshold, so would result in £100,000 in tax, which amounts to about 7% of the farm's total worth. Spread out evenly over 10 years, that would be £10,000 a year. The average profit of a farm is thought to be £45,000. That includes all kinds of farm, and the figure varies from type to type. The figure accounts for all the typical overheads, including income tax, corporation tax, and national insurance payments for employees. Farms do not pay local business rates, though. It also includes employee wages, rental fees on land, and buying tools, fuel, and material. All these price factors are liable to fluctuations, of course, and help make the margins in farming increasingly tight. Assuming the son's farm were to make this amount, 22% of his annual profits would be going to the government in inheritance tax. If the farm were a registered company, not a sole trader, and profits were higher than £50,000 a year, there would also be a corporation tax of 19%. Let's say the farm were to make £51,000 a year pre-tax. The income tax would be £20,400. The corporation tax would be £9,690. Adding the 10% in inheritance tax, the son would be paying a whopping £40,090 in tax per year, or 79% of his total profits. As I mentioned, there are also price factors making the margins tight. Volatile prices for produce, tough deals from supermarkets, wages and labour costs, the rising cost of tools, fuel and chemicals, competition from imports and big agriculture, and environmental obligations. Rent might be being paid on all or some of the land, which could also increase over time. Then we have the emergencies that can befall farmers, a drought, an excessively cold winter, or outbreaks of disease. That £10,000 a year, then, could be crucial in the business surviving or failing. The son might give it a go, struggle for a while, then sell up, or indeed he could be put off entirely and sell before he's even made the attempt. On the other hand, he might weather the storm, with a bit of luck and some very hard work, but this new arrangement would make it much more difficult.